welcome back to my channel. This is where we're going to discuss Silicon Valley Bank. Why did this thing collapse? What was the biggest problems with it? And why did people care so much that was a Silicon Valley Bank collapse? Well, today we're going to have that. We're going to have that discussion, and I'm going to introduce one of my best friends in the world to this discussion. First, we'll just go over why it was a big deal that Silicon Valley Bank collapsed. It was a huge tech hotspot in the early to mid 2000s. A lot of money was pouring into Silicon Valley from the early 2004 all the way up until 2015 to 20. A lot of companies like Facebook, Google, Microsoft were relocating there. So you have multi-billion-dollar companies coming to relocate to this area and pouring a lot of money and a lot of resources in this particular area. That's why it was such breaking news that Silicon Valley Bank collapsed. Now, a lot of these big corporations have relocated, but Silicon Valley was just the first hot spot that a lot of multi-billion-dollar companies located their home bases to and poured a lot of money to that particular area. Now, today we're going to talk about the Silicon Valley Bank. What happened? Why was it so important? What are some of the risk factors, and what are some of the consequences of the collapse? Well, I'm going to introduce my buddy Chris. Chris, Gable.
Hello, guys and gals. I'm Chris. With this subject in mind, he's absolutely correct. The main case scenario here is that Silicon Valley Bank, I'm a programmer, I'm a self-proclaimed financial analyst, and I do keep up with the news, and here's kind of the situation that happened so far as details go. With Silicon Valley Bank, they were invested heavily into very risky assets. Those risky assets were by proxy held by Silvergate. Silvergate is another basically bank that was the liquidity space for any crypto-based exchanges. So you go in, give a Bitcoin, they give you cash. They give you the physical conversion between the digital currency and your physical fiat. So they held a certain amount of liabilities and liquidity. And at some point, of course, with our current crypto universe, we had another crypto winter. With this crypto winter, we were able to see kind of like who was swimming without clothes. While the actual water started to fall away from everyone in the pool, we're starting to see who is grabbing more than they are capable of actually providing.
And the issue with cryptocurrency, everyone, the reason why cryptocurrency has been such a huge hotspot and why there's so much risk and tide involved in it is cryptocurrency is a relatively new investment product. It hasn't been around for, say, 100 years or 1,000 years like stocks, treasuries, and bonds have. It's a relatively new investment product. So the same type of legal restrictions and type of insurance protections that's with stocks and bonds isn't there with cryptocurrency because, one, it's very relatively new, it hasn't been around that long, and two, it's not regulated on the financial markets like other investment products are. As you're saying, Chris?
So yes, and the insurance is very important here because it really does have to do with who's involved, and whoever is involved with crypto cannot be FDIC insured. They're not restricting anyone from actually doing crypto and playing with crypto. However, they will not be backed up by any insurance, especially if they work with it. Now, Silvergate was the direct line, and they had no insurance by proxy. However, Silicon Valley Bank had a tremendous investment in there. Not only this, the second case is that indeed a lot of tech companies were involved here. And if you've ever used Chime, if you ever used any of those online fintech companies, banking apps, whatever, in the end, they're not actually banks. They're tied to a bigger bank like JP Morgan. If you're lucky, sometimes bank corps, and sometimes very small banks with very low liquidity. When these corporations or these mini fintech companies begin to, go under pressure from interest rate hikes, including the bank itself, people want to get their money out. While Silicon Valley Bank basically had this crypto as a hold to maturity, this value decreased by 60%, leaving them with only 40% left of what is actually worth on that particular investment. And if they were to tap into this investment and take it out before maturity, they would be losing 60% of the total value.
You give an example. Let's say you're with Silicon Valley Bank. You throw $1,000 into, say, their cryptocurrency exchange program or investment product that they're offering. Keep in mind, this cryptocurrency, so same legal rules and insurance protection, things like that are not there. Doesn't mean cryptocurrency isn't useful, but just keep in mind the same legal protections aren't there. maturity, you take this thing out before maturity rate occurs. The $1,000 that you threw towards that investment product is only $400. Now you may be wondering, why is this a problem? Well, here's where it becomes a problem. If you try to sell or get this thing out, since the face value what you bought it for isn't worth the same thing, when you eventually try to turn this into cash, you don't get your same $1,000 back. You get back less than half of that. As you were saying, Chris.
Exactly. So basically, they have a piece of paper that says we have enough money, and they can legally put it on their actual paperwork by stating the hold to maturity. However, when it came to push and shove, tech companies, interest rate hikes, and the perfect storm in the economy, especially with inflation being the pilot of this process, we're going to see a lot of companies and banks, especially anything financial related, especially fintechs. Anyone can make a financial technical company by just pairing up with, basically getting a bank as a vendor, and then you just work under their wing. And then you just make an app, and boom, the bank has more customers from your end, and you have an application that supports their bank. When the interest rates were at zero, because remember, after the 2008 crash, a lot of things changed for us, and not only the printer was obnoxiously being run on a 24-hour basis, but interest rates have been pretty low and maintained a low value up to about a 0% value, nearly 0%. So at this point, when you get a credit card with an APR of 2.9, the interest rate was at one point like 0.5. Your bank would profit that 2.4%. And they would make profit off your loan or credit card at that 2.4% mark. But when your federal target interest rate goes up, and now the interest is, let's say, 3%, well, the overall system, the whole economy standard now is 3%. So that 2.9 interest that you originally signed on becomes a 0.1% loss, and then keep going up with interest hikes as we have been doing for the last 2 years, 3 years. Well, 2 years really. But we'll see that companies will start to be in the negative for every customer that they have basically given a really low interest for. Now, this is just a credit card. Let's think of loans. Let's think of real estate. Let's think of anything that has a interest rate value that was at 1.0, and they could bank on top of that whatever percentages they wanted. They can make it look juicy and very low. They can put a 10% on your mortgage, and they're still banking on that 9 point whatever difference. But in the end, when your actual interest catch up and you're still working by the previous value, you now have a negative loss that, in this case, Silicon Valley Bank began to feel. With this negative loss and the constant deposit movement of money back and forth between corporations, their liquidity became very low on hand. And now the collapse is when they actually had and were forced to reach into their unmatured assets that were worth 40% of what they used to be, and realizing that loss of 60%, and then further in, continue with a mathematical equation to see how much money you have to pay out and how much you have left. You will find out that there was about, I believe, $25 billion, maybe even more, but about $25 billion that was unaccounted for in any of the assets that Silicon Valley Bank had.
Yes, and what that basically means is if they had about $25 billion, they had to get paid out to customers that they essentially did not have on hand. Keep in mind, when you're in the banking business, having cash on hand is a very crucial, important thing. Why is this so crucial? Because you're a bank. People have to get their money out. People need to get their cash out. People need this money. And you need the money also as well in a bank in order to invest and grow the money in different things. When you give $100,000 deposit to your bank, Bank of America, Bank of America isn't just going to let that cash sit there and do nothing. Of course not. They're a bank. They're going to take that, say, half that $1,000 that you gave them in cash, take about $50,000 of it, make it as a loan to someone else, and collect interest on that loan. So when the loan is paid off, your $50,000 basically gets put back into your deposit, into your bank account, and that interest they made off of just turning your cash into a loan, it gets put back in their pocket. So it works on both ends. Just that's the basics of it, guys. So which is why it's very important for banks to have money on hand. They need this money. Also, in general, obviously every U.S. corporation needs money to operate. But banks need it even more because if they don't have enough cash on hand to meet their depository requirements, whatever that may be, whether it be crypto or taking out cash in general or whatever, they're going to run into a problem to where they simply just cannot operate anymore, or they have to use other means in order to do that. And despite what everyone may think, banks actually are not allowed to print their own money. Only the U.S. central bank can do that. Banks can't print out cash from nowhere. That's why the U.S. central bank can always create loans, because they're allowed to print their own money. Banks can't actually do that. So when they run into things like Silicon Valley Bank did, where you run out of cash to meet your depository requirements, you have no other choice but to simply shut down or figure out something else if you can. Or get a loan out is what most banks tend to do.
Right.
As you're saying, Chris, you want to sum it up for us?
Well, it continues. It's not over, so there's no sum yet. But the main case that we're at now is Signature Bank in New York is another one that is collapsing because of the Silicon Valley Bank. Now, you're going to notice a lot of smaller banks begin to, forcefully
close or shut down because the issue what we talked about, guys. Banks are going to put your depository cash into somewhere else to make money for you and everyone else. This is not illegal. This is how banks operate. This is their business model. So
not to mention that banks basically own each other's shares and own a lot of each other's debts. So when one banks begin to not be able to pay off anything, then it affects the bigger banks in return. So the escalation could be pretty drastic.
Yes, and it snowballs. With this bank, a huge bank collapsing, could affect 10 or 20 or who knows how many other smaller banks who either those smaller banks either gave loans to the bigger bank for, or maybe those smaller banks had some of their own assets invested into that bigger bank or that bigger asset. So when it collapses, that's why so many other smaller banks could be affected and why it could affect so many people so quickly.
The current remedy that's tried or is being tried is not a bailout based on any political means, but is a bailout when you consider the effect of the people of the country. You're going to see that they're basically using $25 billion that they will essentially, or has been printed as a means to support. And this printed value is actually something that was kind of kept in from 2008 as a reserve. But releasing this money back into in circulation, sure, is not a bailout because it's not taxpayer money. However, it's another case of inflation, and we have to realize that inflation is also a technical tax. So when our inflation does increase, we also do pay more to Uncle Sam through other means, including the fact that they already dilute more and more into our money supply.
100%. Now, we're going to keep an eye on Silicon Valley Bank, everyone, especially if you'd like us to. We'll keep everyone updated. If you want more detailed explanations about how everything maybe manifests from the beginning, we'll make sure to keep it posted, or just simply post in the comments below, and we'll keep an eye on everything on the news, and we'll see how this transacts in the next coming months.